Development is the process of improving the conditions of people through the diffusion of knowledge and technology. Every place lies at some point along a continuum of development. A developed country, also known as a more developed country (MDC) and referred to by the UN as a very developed country, has progressed further along the development continuum. A developing country, also frequently called a less developed country (LDC), has made some progress toward development, though less than the developed countries. To determine the level of development of every country, the UN created the Human Development Index (HDI). Geographers refer to the HDI scores to divide the world into 2 developed regions and 7 developing regions. In addition to the 9 regions, 3 other distinctive areas can be identified. The UN measures the standard of living in countries through a complex index called Annual Gross National Income per Capita Purchasing Power Parity. By dividing GNI by total population, it is possible to measure the contribution made by the average individual toward generating a country's wealth in a year. Some studies refer to gross domestic product (GDP), which is also the value of output of goods and services produced in a country in a year. Per capita GNI, or, for that matter, another single indicator cannot measure perfectly the level of country's development. Average per capita income is higher in developed countries because people typically earn their living by different means than in developing countries. The contribution to GNI among primary, secondary, and tertiary sectors between developed and developing countries. Workers in developed countries are more productive than those in developing countries. Workers in developed countries produce more with less effort because they have access to more machines, tools, and equipment to perform much of the work. Development is about more than wealth. The UN considers years of schooling to be the most critical measure of the ability of an individual to gain access to knowledge needed for development. To form the access to knowledge component of HDI, the UN combines 2 measures of years of schooling. Years of schooling for today's adults and expected years of schooling for today's youth. Other indicators can measure regional variation in access to knowledge. The pupil/teacher ratio is the number of enrolled students divided by the number of teachers, and the literacy rate is the percentage of country's people who can read and write. Improved education is a major goal of many developing countries, but funds are scarce. Adding to the challenge of teaching and learning in developing countries, most books, newspapers, and magazines are published in developing countries, in part because more of their citizens can read and write and can afford to buy them. The UN considers good health to be an important measure of development as wealth and knowledge. From the mental health and medical indicators, the UN has selected life expectancy at birth as the contributor to the HDI. People are healthy in developed countries than in developing ones. Better health and welfare also permit babies to survive infancy in developed countries. Part of the wealth generated in developed countries is used to purchase goods and services. Telephones enhance interaction with providers of raw materials and customers for goods and services. Products that promote better transportation and communication are accessible to virtually all residents in developed countries. Motor vehicles, computers, and telephones are not essential to people who live in the same village as their friends and relatives and work all day growing food in nearby fields. Because the possession of consumer goods is not universal, a gap can emerge between the haves and the have-nots. Technological change is helping to reduce the gap between developed and developing countries in access to communications.
Key issue 2 discusses inequalities. The first thing to discuss is IHDI, also known as Inequality Adjusted Human Development Index. IHDI modifies HDI to account for inequality within a country. The lower IHDI is than HDI shows the amount of inequality. Here you can see the IHDI averaged by region. The lower the bar, the more inequality. Sub-Saharan Africa and South Asia have the lowest IHDI scores, while North America and Japan and South Korea have the highest. As you can see, LDCs tend to have more inequalities than MDCs. On this map here, you can see the score by country, which further cements what the graph told us, with the lowest scores being seen in Southern Asia and Sub-Saharan Africa, and kind of in Latin America. We will now discuss Wallerstein's core and periphery theory, also known as the world systems theory. This theory states that MDCs form a core, while LDCs will form a periphery around that core, which is clearly visible on this map here. On this map here, a simple line can separate the MDCs from the LDCs, the only exception being Australia. However, due to more countries becoming more and more developed, specifically Latin America and Asia, this may soon not be the case, with multiple lines being need to be drawn. Next, we will talk about inequalities within countries. Inequalities within countries exist everywhere, developed or not. We can tell how much inequality is within a country by comparing the regions in terms of GPA per capita, as seen on this map here. Using this map here, try to guess which country has the most inequality. If you turn and guess, it's Brazil, since there's a bigger difference between their regions than Turkey. Not only that, the wealthiest regions are concentrated along the coast and in the center. Current trends of inequality within countries and MDCs like the US and the UK is that inequality so far between the rich and the poor is increasing, when before 1980 it used to be decreasing. We will now touch on the serious topic of inequalities between genders. The UN uses two measures to measure the inequality between genders: the Gender Inequality Index, also known as GII, which we will be seeing shortly, and the Gender Development Index, known as GDI. So far, the UN has not found a single country where women are treated as equally as men. GII measures the gender inequality in three areas: reproductive health, empowerment, and the labor market. The higher the GII, the greater the inequality. Here we can see the general regions with the highest GII, highlighted in blue, also had the lowest IHDI, the regions being Sub-Saharan Africa and Southern Asia. The ones with the lowest score, dark purple, also had the highest IHDI, namely North America and Europe. Empowerment is the ability to seek improvements in one's status through political or economic power. This map here shows the amount of women in legislature. Quite a few different regions have very few women in legislature, like parts of Sub-Saharan Africa and most of Asia and East Europe. Here we can see that Europe and North America tend to have the most amount of women in legislature. Empowerment also reflects the differences of genders in high school, as seen on the next map. Here on this map, we can see that around the world, it seems that more men have completed high school than women, with a few exceptions, namely being most of Latin America and the US. It's also seen here, surprisingly, that there are more men completing high school in Europe than there are women. This map here shows the amount of women in the labor force. It's surprising to see that Sub-Saharan Africa has more women in the workforce than Europe or South Asia does. But this is most likely due to the impoverished conditions, with women having to work mainly in agriculture in order to keep their families, fed, clothed, and sustained for. East Asia and Southeast Asia also have a large amount. While reproductive health may not seem that important, in many countries it is a major contributor to inequality. These graphs here show you two different things that account for reproductive health. The one on the left shows the maternal mortality rate, talked about in Chapter 2. The one on the right shows the adolescent fertility rate, which is the number of births per 1,000 women ages 15 to 19. Both of these maps show similar trends, with rates being highest in Sub-Saharan Africa, Southern Asia, and parts of Latin America. Next, we will move on to GDI, which measures the gender gap in three sections: income, education, and life expectancy, similar to HDI. If both females and males had the same score, GDI would be 1. The overall score for females is 0.705, while for males it's 0.749, so it's actually surprisingly close. This map here, which measures GDI by country, also follows the same trends we saw with the other maps, with most of Africa and South Asia having the lowest scores. To end on a positive note, GII around the globe has been decreasing in all but 4 countries since 1990, and is still currently decreasing. But overall, it remains clear that LDCs tend to have, in most areas, more inequalities than MDCs. But that does not mean that MDCs don't have inequality, especially between the rich and the poor. We will next be moving on to the development strategies and finance with Violet.
To develop, developing countries have to choose which strategy they would like to use: self-sufficiency or international trade.
The self-sufficiency path promotes all things internal and persuades citizens to avoid out-of-country resources, products, and foreign ownership. To push out others and focus on a country internally, they will do the following things from these 4 categories. Import barriers. In order to import to a country, importers must have a license, and getting this license is intentionally made very difficult. Once they have the license. They will be met with quotas that limit the amount of imported products. They will also be met with high taxes and tariffs used to make their product less appealing to citizens. Isolation. For native businesses isolated from competition with large powers, protect the business from other businesses and government choices from MDCs. The government also encourages independence of these native businesses. Equal investment. Investment is made equally spread among regions and sectors of a country's economy as possible. Equal income. Citizens of a city or rural settlement have equal income, and reducing poverty takes priority over having a select few wealthy customers. Self-sufficiency was eventually rejected by most countries because of the large problems found with this strategy. Here are 3 categories. No incentive. With having such a long list of customers whom can only really buy from them, businesses lack the want to lower costs, increase production, or other developments. Because companies don't have to compete with larger companies and are protected from the government, they don't really care to keep up with technological advancements, or sustainable development, or environmental protection. Corruption. With unmonitored power within the non-elected administrators, this encourages abuse and corruption of this system. Black market. Businessmen realize it's more profitable to illegally import goods and sell at a high price than to struggle with all the restrictions to produce the goods themselves. In the late 20th century, when international trade became popular, requirements were put into place for a country to evaluate its abundance of animal, vegetable, and mineral resources, along with the products that can be manufactured and distributed at a better efficiency. This approach helped a country economically develop, and the funds that came from the global market can be used to finance other development. In the 1950s, Rostow proposed a 5-stage model of development, in which every country has followed upon one of the 5 stages. In the first stage, the stage is not yet a stage of development. In this stage, there is a high workforce in agriculture and national wealth allocated in unproductive areas such as military or religion. The second stage has a group of elites who take initiative to foster innovative economic activities. Under the elites, the country starts to invest in technology and infrastructure, such as water supplies and transportation systems. Developing, and with the new international funding, the importance of constructing infrastructure is emphasized, and this fosters increase of productivity. In the third stage, a select few economic categories experience fast growth, such as textiles or food products. These categories will become more advanced with technology and become more productive, while other industries will still be traditionally dominated. 4. In this fourth stage, the growth will then spread to other industries, and workers will become more skilled and specialized. In the fifth stage, industries will shift from heavy industries such as steel or energy to consumer industries like motor vehicles or refrigerators. Trade increased faster than wealth in the late 20th century and early 21st century. This was after many countries had switched over to international trade, and this newfound optimism was based on 3 things. Other countries' success. Developed countries in Europe and North America were joined by others such as Japan and South Korea through international trade. So if they could become more developed with international trade, why couldn't other countries? Resource riches. Developing countries contain a large amount of raw materials sought for by manufacturers and producers in developed countries. Although originally taken by European colonial powers, in the global economy these resources could generate funds towards development.
International competitiveness. In international trade, the needs, preferences, and demands for customers around the globe are beneficial for countries focusing on international trade. For takeoff industries to stay competitive, constant evaluation of changes in international consumer preferences for product engineering, design technology, and marketing strategies are needed. This need for competitiveness in exporting takeoff industries can benefit other sectors of the economy. Created by countries that compile 97% of global trade, the World Trade Organization was established in 1995 with the purpose to promote the international trade development model with two main principal approaches: reduce restrictions. The WTO works to eliminate international trade restrictions on manufactured goods like government subsidies for exports, quotas for imports, or tariffs on exports and imports, and eliminate restrictions on the movement of money by any means such as banks, corporations, and wealthy individuals. Enforcement. The WTO also enforces agreements the organization has made or protects patents that an individual or corporation has, considering the age of Internet. The organization will then decide whether or not an accusation is true and act upon it. Critics are not fond of the WTO and constantly have protests outside the street of important meetings. They claim the WTO is anti-democratic because decisions are made out of public view to assist interests of large corporations than support lower-class people. Conservatives say that the organization violates a country's sovereignty and comprises its power, as they can change taxes and laws they feel unjust toward trading practices. While others chose a self-sufficiency route in the 20th century, these following groups chose international trade. Often called the Four Dragons or Tigers, South Korea, Singapore, Taiwan, and Hong Kong became the trade superpowers in Asia. Singapore and Hong Kong were British colonies till 1997 and 1965. They were large cities but with small rural lands and little resources. Considering they had little resources, the Four Dragons developed in a way concentrating on manufacturing a select few goods, mainly clothing and electronics. With low labor costs, the dragons could sell goods to developed countries at a low and inexpensive price. Saudi Arabia, Kuwait, Bahrain, Oman, and United Arab Emirates are Arabian Peninsula countries who were known to be some of the least developed countries. But due to rising petroleum prices in the 1970s, they become some of the wealthiest countries in the world. Using funds from their petroleum businesses, they finance large projects to work on infrastructure such as highways, hospitals, housing, and more. Other factories like steel, aluminum, and petrochemicals compete in global markets with the help of government subsidies. The landscape also changed drastically with diffusion of consumer goods, with supermarkets in the peninsula containing products imported from Europe and North America. In order for international trade to work, corporations that are based in certain countries are required to make investments into other countries. This is known as foreign direct investment, or FDI. FDI has grown from $172 billion in 2002 to $646 billion in 2016. Investment isn't equally distributed, with only one-third going into developing countries. And from that, one-third goes to China, and one-third goes to Brazil, Singapore, Russia, and Mexico. Most FDI resources are from transnational corporations that invest into countries they have headquarters in. Of the 500 large corporations,
344 have headquarters in developing countries. Of those, 126 are in the United States. Of the 156 headquarters in developing countries, 126 are in China, including Hong Kong. India is a great case study as it can be used as an example for both self-sufficiency and international trade. After breaking away from Britain in 1947, in its independence, India chose to become a leading example in a self-sufficiency strategy. India followed some basic principles for self-sufficient countries, such as licenses for importing, import limits, and heavy taxes. But another thing that they had done was to have a non-convertible currency, so that their money could not be converted into other currencies. As well as regulate imports, India also controlled its internal companies as well. To do this, India requires a permit for many important decisions, such as selling new products, to hiring and firing employees. When a business is unprofitable, it will get help from the government by funding it to stop it from going under. And the government also owns businesses that are traditionally owned privately in other countries, such as insurance and automakers. In the 1990s, India got rid of the tariffs, permits, quotas, and other barriers in order to become an international trade-focused country. With a newfound competition with international companies, Indian companies made improvements in their products. The Indian government also sold some of their companies. India's GDP per capita also rised from $300 in 1990 to $1,900 in 2017. The World Bank includes the International Bank for Reconstruction and Development (IBRD) and the International Development Association (IDA). The IBRD provides loans to countries for them to develop and invest in projects to benefit the people, and the IDA provides for the countries who are too risky to give loans. The IBRD gets money from sale of bonds to private investors, while the IDA gets funds from government contributions. 40 billion loans are made yearly, 14% to India, and around 5% each to China, Mexico, Turkey, Brazil, Indonesia, Pakistan, Bangladesh, and Vietnam. The World Bank and IMF, International Monetary Fund, were made in the UN conference in New Hampshire to promote economic development and stability after World War II, and to avoid policies that created the Great Depression. Made by Muhammad Yunus, another loan agency was made for women called Garem, making thousands of loans to women in Bangladesh and neighboring South Asian countries. Payments were only missed 1% of the time. Another organization providing for women in Bangladesh is Bangladesh Rural Advancement Committee. And for people who are too poor to get regular loans, they use microfinance, which gives out small loans and financial services. IMF, mentioned earlier, used to give funds to help expansion of international trade, and funds are given based on size, relativity in the world economy, than specific projects. Developing countries borrow money to improve infrastructure such as electricity or water supply. These improvements would then attract foreign companies or expansion, giving additional taxes to pay off debts and other things. But the World Bank deems half of funded African projects to be failures, either due to poor engineering, money is used someplace else, or stolen, or the infrastructure doesn't attract investment. And some countries can't even pay back the original money they had borrowed. The debt also exceeds income in some countries. Due to this, no more loans are given, so the needed infrastructure is not built,
and the inability to pay back loans affects banks in developed countries as well. When a country's in a rough spot, there are two strategies to go with. These two strategies have countries divided into which one's the most optimal. The first is stimulus. This is where a country will intentionally go into debt by using funds for infrastructure projects that they need. Then once the economy recovers, more taxes can be paid to pay off the debt. The second is austerity. It is argued that taxes must be reduced to let people and the economy revive, and that government programs need to be cut to reduce inflation and debts as much as possible. Presidents Bush and Obama used the stimulus strategy to recover from the downturn in 2008. After the success of Tea Party candidates in 2010, austerity was paid more attention. The division in Europe between the two may even cause the downfall of the euro currency. But the IMF, World Bank, and economically healthy countries forced struggling countries to adopt the austerity program to apply for debt relief. Austerity is enforced through the Policy Framework Paper, PFP, outlining the Structural Adjustment Program, which is a program that gives goals and strategies to a country. It mainly entails spending only what one can afford, benefits to the poor, funding productive economic activities, move resources to more impactful areas, as well as more structured and open government. Critics say that these programs punish Earth's poorest countries and people, leaving them vulnerable to wealthier countries. Because of this downside, there has been consideration to return to self-sufficiency. International organizations say that without these programs and its reforms, the poor will suffer more. The IMF and World Bank have encouraged programs to reduce poverty, corruption, and to connect with citizens more, put in place to ease short-term pain.
Since 1980, GNI per capita has increased much more rapid in developed countries than in developing countries. Mean years of education has increased by around the same number in developed and developing countries. Life expectancy has increased by around the same number of years in developed and developing countries. The gap in HDI between developed countries and developing countries has narrowed, but the HDI has increased more rapid in developing regions than in developed ones. To reduce disparities between developed and developing countries, the 193 members of the United Nations adopted 17 Sustainable Development Goals in 2015. Fair trade has been proposed as a variation of the international trade model of development that promotes sustainability. The fair trade movement focuses primarily on products exported from developing countries to developed countries. 3 sets of standards distinguish fair trade. 1 set applies to products, a 2nd set to workers on farms and factories, and a 3rd set to consumers, especially those living in developed countries. Fair trade producer standards. Without raising incomes of small-scale farmers and artisans by eliminating some of the middlemen, distributing the profits and risks associated with production and sale of goods more fairly among producers, distributors, retailers, and financiers, increasing the entrepreneurial and management skills of the producers, promoting safe and sustainable farming methods and working conditions, such as by prohibiting the use of dangerous pesticides and herbicides and promoting the production of certified crops. With the cooperation can qualify for credit so that funds can be borrowed to buy equipment and invest in improving farms. Materials can be purchased at lower cost. The people who grow or make the products democratically manage allocation of resources and assure safe and healthy working conditions. Profits are reinvested in the community instead of going to absentee corporate owners. Fair trade worker standards without oversight of workers' conditions by governments and international lending agencies is minimal. Workers alleged work long hours in poor conditions for low pay. Children or forced labor may be in the workforce. Health problems may result from poor sanitation and injuries from inadequate safety precautions. Injured, ill, or laid off workers are not compensated with paid fair wages, at least enough to cover food, shelter, education, healthcare, and other basic needs. Permitted to organize a union and to have the right to collective bargaining. Protected by high environmental and safety standards. Most fair trade sales are in food, including coffee, tea, banana, chocolate, cocoa, juice, sugar, and hunt products. Buying fair trade products helps consumers connect more directly with the producers of the food, clothing, and household items that they buy.